Welcome back to our mini series on profiting with Index Universal Life. Today we're going to be looking at our next premium carrier, Allianz Life, and explore how they're able to leverage their position as one of the carriers in the forefront of the IUL market to maximize their policyholders' gains. Allianz Life's unique position in the market essentially allows them to cut out the middleman and capitalize on better participation rates and balanced index strategies so their clients can outperform year after year. Allianz has redefined the index universal life market in ways that we don't see with other carriers. So today we'll take a look at some of the interesting notables about the carrier, their unique crediting strategy, as well as some key Allianz index features that allow their clients to lock in great gains and grow their policy and personal wealth consistently. So let's dive in. By the way, my name is Joseph Gutierrez, and this is Covered in Compounding. Click like and subscribe to learn how we use high cash value life insurance as the foundational asset to build our wealth over the long run. Now, Allianz Life has a unique reputation in the IUL industry as being the leader of the pack, so to speak. As a brief summary, Allianz was founded in 1892 and has since built an investment-grade portfolio worth $124 billion. They have a AA rating from Standard & Poor's and an A+ superior rating from AM Best for their high liquidity, stability, and strength. Now, one of the big notables that Allianz brings to the Index Universal Life market is that they own their own market trading desk and hedging team. So, a little bit of background. When an insurance carrier seeks to provide market-like returns based on unique index strategies for their policyholders, they turn to investment banks. These investment banks have their own specialized index funds and hedging teams to maximize returns while reducing volatility. For this service of returning the expected index crediting back to the policyholders, the insurance carrier has to pay the investment bank a fee. That fee is a carrying cost that either gets eaten up by the insurance carrier or, most likely, gets translated to reduced participation rates and/or tighter caps for the policyholders. This means our potential gains may be negatively affected. Now, this is an example of what's called static hedging. The insurance carrier is offloading risk to the investment bank, and the investment bank credits the policyholder back based on the index performance. Conversely, Allianz Life gets around this potential problem by making their own market trades and using their own fund management company, Allianz Investment Management US LLC, a wholly owned subsidiary of Allianz Life, to help produce the index crediting directly, bypassing the outside investment banks. Now, this is referred to as dynamic hedging. Dynamic hedging is essentially internal portfolio managers along with their quants, or also known as quantitative analysts, creating and running models adjusting the underlying portfolio positions daily and sometimes multiple times a day. Internally, they replicate the index performance with derivative trades, calls, puts, futures, those kind of things, and help pass the index crediting back to the policyholders. They essentially bring the investment bank in-house. It is something that Allianz budgets for and takes seriously so they can return outsized gains to their policyholders. Any company that can bring more of its services in-house and reduce costs will be much more efficient and have better participation rates and better opportunities for better, greater returns than insurance carriers that don't. Allianz is unique in the IUL market for this. Another notable that is unique in the industry is their lock-in functions. This essentially means the policyholder can lock in their gains at any time during the segment period, assuming they are positive or in the money, as they say in the options world. This is a pretty big deal because it can substantially reduce the likelihood of a 0 year. So if we have a spike in the market, say halfway through the year, we can manually lock in our gains, potentially bypassing a market drawdown later on. This manual lock feature is exclusive to Allianz Life and partially because of their use of dynamic hedging. Allianz also has an auto lock function where they can put in what amounts to limit orders on the index positions. So for instance, let's say we are doing well and we have an unrealized profit of 10% 9 months into our segment. We can elect to put in an auto lock to say the upper limit of 12% and the lower limit of something like 8%. Now, if the price action of the index reaches any of our limits, Allianz will automatically lock in that gain. Now, it's important to remember that once the lock-in takes place for that year segment, we're going to receive our crediting at the end of that year. So the logic goes that we could lock ourselves into a solid gain at the top of the market or lock ourselves too early and miss additional markup. All that said, though, Allianz has done studies and has noticed that their policyholders do quite a bit better with the locking functionality than without. Remember, it is optional, but it does give clients peace of mind knowing that they can lock in their gains whenever they want. It's also great for seasoned market traders that want more hands-on approach to their assets. In practice, when it comes to me and my clients, it could look like something like, say the market jumps 25% on a relief rally and I'm your agent. Expect a call or email from me saying, hey, your index has made an outside move upwards. You might want to consider locking in these gains or at least put in an auto lock lower trigger to protect what we've made. Now, the last notable that I'd like to share with my clients is that we can blend up to 10x on our base amount with a minimum base of $100,000. For juveniles, it's 5x. We've talked about blending and its huge benefits to building cash value. Actually, in our last video of this series, will be all about blending, but essentially allows us to push up our MEC limits way up by having that $100,000 base and up to another $1 million of supplemental term attached to bring our total face amount to $1.1 million. We like blending because it keeps our costs significantly down and our MEC limits up, so we can toss in much more money towards our cash value. This boosts our policy's cash value and gives us more future tax-free capital for our business, our investments, retirement, or whatever projects we're going to be taking on. And if we're looking to maximize our policy, then Allianz is the head of the pack on this measure as well. So now that we've got the notables here out of the way, let's jump into the index strategies and the performance so we can maximize our cash value over the long run. Okay, so now that we got some of the notables out of the way, let's go ahead and look at the various index crediting strategies that Allianz gives us here and kind of give a better feel for what we can choose here. Now, there's a lot going on here, many different options, so we're going to try and break it down and make it a little more digestible. Okay, so if we focus in on the rightmost side here, we'll see this annual point to point. Okay, so just as a refresher, the way these index crediting strategies work is they're 1 year options is the underlying functionality here. So basically, for instance, we go from January of, say, 2024 to January of 2025. And then we monitor the initial value of an index to the final value of the index over that 1 year time frame. So if we're starting off at, say, value of $1,000 for that index, and 1 year later it looks like 1,060, then we know that we made a gain of 6% on the underlying index, and then we apply our participation rates. Okay, and also remember that because it's Index Universal Life, we have that 0% floor. So if we do get a negative year, it translates into a 0% at the very least. Okay. Now let's focus in here. We have these different allocation choices here. We have the select, the bonus, the classic, and the standard. Okay, so if we start the standard at the bottom here, this is based on the S&P 500 index. Just about every carrier has their own S&P 500 index selection here, but we want to make notice that this particular one has a cap, and I know we like to focus in on indexes that don't have a cap, but just keep in mind that for most carriers with the standard S&P 500 index, their caps are much more constrictive, much closer to 8 to 9%, and we see this that Allianz is giving us a solid 12.25%. Okay, that's because of the efficiencies of the way Allianz does things and the dynamic hedging. They're able to give us less constrictive caps and better participation rates. Okay, let's go ahead and move on to kind of the more popular selections here. So let's focus in on the Classic next. So the Classic has all these different options. We have the Bloomberg, the PIMCO, the Blended Futures Index, and the S&P Futures Index. Three of them are excess returns, and the Blended Futures has its own volatility control as well. Okay, each one also has their own participation rates. Okay, so in this case, 190%, 185, 115, and then 75% participation rates. So what's nice about the Classic version here is that after our participation rates are applied, we get an extra 1% bonus. So it's just a hard 1% bonus tacked on based on whatever that index is doing. So for example, if we're allocated to the Bloomberg US Dynamic Balance number 3 ER index, that's a mouthful, but yes, we say get 10% for that year. Okay, so then if we're credited 10% on the underlying index, we have to multiply it by our participation rate, so 1.9, and then that product there, we add an extra percent. So if we do the quick math on that, we would our Bloomberg index would translate into 20% crediting. Not bad, not bad at all. Remember that with the Classic allocation here, either one of these, if we do get a 0 year, we're at least going to get that 1% credit to us. So it's a nice way to kind of get at least something if we do have one of those 0 years that happen every once in a while. A lot of my clients, kind of more in retirement, that want to have at least some kind of crediting even in a bad year, usually incorporate the Classic version. Okay, next is the bonus allocation. So same thing, we have our participation rates. The main difference with the bonus is that we get a 15% multiplier. Okay, so the way that works is it's basically an enhanced or an additional participation rate. Okay, same idea. If we make 10% on the Bloomberg, we multiply it by 1.85 times 1.15, and that product there is what's credited to us. So that's a little over 21%, I believe. Not bad. Okay. Moving on, here is the Select version. Same idea. It's just an enhanced multiplier. Okay, so the difference here is that instead of a 15% multiplier, we get a 40% multiplier. The only downside with the Select version is that we also have a 1% fee. So minus 1% is kind of a minus hard 1% fee at the end. So if you're particularly bullish on the market, you may get the best gains compared to the other selections, but we do have to remember that whatever our final crediting rate is, we do have to subtract 1%. So in essence, if we do have a 0 year, we're at least have to pay 1% fee from our cash value. So it's something to keep in mind. It's kind of it's a little more of a riskier option, but we do capitalize on very positive years quite a bit better. Okay, and then briefly here on the leftmost side here, we see a fixed interest rate here of about 5.4%. That's a bit particularly higher than the standard for the industry. For a lot of other carriers, we're in the 4%. Once again, Allianz, with its dynamic hedging and efficiencies built in, are able to grant us a bit more interest, even on the fixed interest option. Some of my clients that are maybe a little bit wary of the market for that particular year, or coming from like the whole life world, may want to allocate a certain percentage of the total portfolio to fixed interest. And with Allianz, we get a pretty impressive fixed interest rate of 5.4%. So that's always an option. Okay, then next is the S&P Index trigger. So the trigger is kind of nice because it allows us to kind of get as long as our annual point to point is positive for that year, it gives us basically a guaranteed 8.25%. So if we're up 0.1% or if we're up 30%, our end of the year crediting is 8.25%. Now, if we're down, if we're negative on the underlying index, it translates into a 0 year. Okay, and we'll see that as well. Last one here we'll touch on briefly here is the monthly sum. Okay, so instead of an annual point to point, we're going to be doing a monthly point to point. So the way that looks is, say we have January, February, March, April, blah, 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 all the way down for the entire year. So the way that works is that each month has a cap of 3.8% for that particular month. And we monitor each month and then we add them all up, and whatever that summation is there is what's going to be credited to us. Okay, so if January has a 1% year, February has a minus 1% year, March has a 3.8% year, hits the cap, we're going to add all those numbers up over the 12 months, and then that is our crediting for that year. Okay, now let's jump over to the different index allocation options here. We'll start with the blended futures index. What's nice about this blended futures index, obviously it's a excess return, volatility controlled excess return type of index, but it has this 60-40 split between equity and bond allocations here. And if we focus in, we notice that the 40% of the index is allocated towards the 10-year future Treasury notes. We have 30% going towards the S&P 500 futures, 20% going to small caps, and then the last 10% towards international markets or emerging markets. Okay, so if we kind of focus in here, let's go ahead and take a look at its performance over the last few years. We can see all the different allocation options here. We have our classic, our bonus, and our select. Okay, we can see over the last few years how they've performed. And we do notice that they're pretty much in line with each other. The larger the index return, obviously, the bigger the difference between each of the classic, the bonus, or the select versions. But we can see pretty good gains over the last few years. From 2020 to 2024, we can see some very positive years, 2016, 13, 1%, and so on and so forth. So we're having great returns on kind of the more classic 60-40 split that a lot of financial advisors out there may recommend to their clients. Okay, moving on here. Next is the Bloomberg US Dynamic Balanced number 3 ER Index. Okay, this is kind of the new and improved Bloomberg index choice here. And we can see that it is allocated towards large cap US equities, small cap US equities, and the technology sector. Okay, and that's kind of its breakdown. It's either in equities or cash, and it's kind of managing the risk and exposure in that way. And if we kind of focus in here, we can see great gains on this relatively new index. Now, there used to be a version 2 out there that had a bond allocation that has since been removed, and we kind of see, remember the whole back testing thing where they can kind of value the index's potential gains over multiple years here. And we can see that the Bloomberg Balance 3 here done quite well in the last few years. Okay, so as the years goes on, a lot of these different carriers will update their index choices here so that we can get the most gain possible. As the market moves and changes, so do our index allocations and choices here. And the Bloomberg is a good example so that we can get better returns than other indexes. Okay, so this is a good particular strategy if we want to be exposed to more heavy on the equity side, the U.S. equities, especially the tech sector as well. This is a good one for that. Moving on here, maybe the most popular one, or one of the most popular ones, is the PIMCO Tactical Balanced ER Index. Okay, PIMCO, you may have heard that. in the Wall Street world there, Allianz actually owns PIMCO, and they have a great uh, index strategy. Okay, so in this particular index strategy gives us the U.S. equity futures custom index, which is based mostly on the S&P 500, and then a portion of it is allocated to a synthetic bond index, which is basically treasury bonds, maybe some corporate credit, something like that, investment grade bonds. Okay, and then we can also see how we've done over the last few years here. Okay, in the classic, the bonus, and the select, we see slightly different participation rates with different multipliers and different bonuses. Okay, and the same kind of math that goes behind it. We have at least a 1% bonus on a 0 year for the classic version. There's no hard 1% bonus in the bonus version, and then the select version, if we do get a 0 year, is a negative 1% for that return. But conversely, if we do have a great year, we have outsized gains. So if we looked at, say, 2010, our index did 11% for that year. The select outperformed all the other ones, notwithstanding that 1% asset charge. We still got a 26.72% year. So pretty strong returns. I know for myself, I'm actually allocated towards the PIMCO balanced ER index, and it's done quite well for me as well. Okay, moving on is the S&P Futures Index. Okay, so remember with the S&P Futures, it's a very popular kind of basket of stocks here, and the participation rates and or caps are a little more restrictive. So in this case, we see that the S&P Futures is based on S&P 3-month E-mini contracts. Because it's based on the futures, we are able to get a decent participation rate and kind of ride along on the strong growth of the S&P 500. Okay, the S&P 500, arguably probably the best index out there, but at the same time, the most amount of volatility and or option activity that kind of makes it more expensive compared to some of these custom indexes and strategies. Okay, so if we look at the last year here in 2024, we see that even with a 75% participation rate, we'd still got a very strong crediting for that year. We have 14.6%, the bonus version slightly higher at 15.4%, and the select at 16.2%. And we can kind of look at all the years leading up to that and how strong they are compared to the actual index return. Okay, and we'll just touch on briefly what we talked about earlier. Okay, this different allocations here for a trigger, the monthly sum, and then just a simple point to point with a cap here. And we can still see fantastic gains even with just the standard S&P 500. Why are we getting such good gains, such good triggering, and higher caps? Well, because Allianz Life is has the dynamic hedging and is very efficient with its allocations. Okay, so we're able to get outsized gains in that respect. Okay, now one last thing we'd like to focus in here is the 0% floor. We haven't talked too much about this. We made mention of it a few times here, but it cannot be overstated. So other insurance brokers and the such will use, the 0 hero and all these cheesy phrases, but essentially, whenever the market does poorly for that particular year, if our index is negative, we get to skip over those losses and we don't incur them in our cash value. Now, this is huge in the long run, and it's something that I think gets overlooked. And if we kind of focus in here, so let's go back to the S&P futures. And I bring this up because there's quite a few of those, financial gurus that we've heard about for the last 30 plus years giving the same kind of tired old advice, basically saying to the effect that, IUL sucks and permanent life insurance sucks and maybe term, but put all your money in an index fund and you will outperform those other products. And my response to that is, are you sure about that?
You sure about that? You sure about that?
because if we actually look at some numbers here, we see the opposite. So let's say we are looking at the S&P Futures Index ER, which is pretty representative of the actual S&P 500, their total return type of index. Let's take a look here. Let's say the last 5 years. So from 2020 to 2024, if we look at the underlying index and we compare it to, let's say, the same situation, try and do an apples to apples comparison the best we can. Let's say we're in the bonus allocation with the 75% participation rate and the 15% bonus multiplier. Okay, so if we do the quick math on this, let's try and make an apples to apples comparison. Let's say we have $100,000 in a brokerage account or some kind of 401k tax deferred account versus $100,000 sitting in our cash value. If we do the quick math on this, let's say we're looking at the brokerage account first, we would take our $100,000, okay, we allocate to this index, and let's say we have that compound interest effect over 5 years, so we take the $100,000 times the gain of 17.5% times the gain of 27%, so it would look like $100,000 times 1.759 times 1.2799, and so on and so on. Not forgetting that in 2022 we did have a negative year, so we would have to multiply by 0.8027 to kind of show that drop off 20% on our value there, on our account value. The end product it would be $170,000 and some change. Now, we also have to factor in, because it's an outside taxable account, let's say it's our separate brokerage account, is that we have to pay capital gains on our profit. So we pay capital gains on the $70,000, say it's 20% goes to the government, well, we're left with $156,000. If it's a 401k or some kind of traditional IRA, it's even worse because we have to pay regular income tax later in life. We don't even have access to it in our working years, but let's say later in life. It's hard to say exactly, depends on your kind of your tax bracket there, but let's say it's a 30% goes to the government, we would have, $119,000 or so of that $170,000. So the 119 is what we're left with. The rest goes in tax. Now, contrast that with what we would have made if we were in an index universal life policy, say with Allianz, this bonus over the last 5 years, same thing, do the same math. Let's say we have $100,000 cash value and we do the same multiples here. So let's see, 2020 had a 15% year, 2021 has a 24% year, 2022 is a 0% year, so we'd multiply it by 1, and 17%, 15%. We do all the math on that, the quick math on that, and we have $192,000, which is higher than the 170. Also, don't forget is that we can access that money anytime we want, and we can utilize any of the loan features to get that money tax-free. Now, a popular strategy would be to utilize the fixed loan option, and assuming that we can do what's essentially called a wash loan, where our crediting and our interest expense with the carrier are the same, we have access to almost that full $192,000. So it's a difference of either 119-ish or 156 or the full 192. So basically, our IUL in this example would have outperformed by 40 to, $70,000, and that's only 5 years. Imagine 10, 15, 20, 30, 50 years of gains. What kind of gains are we giving up by utilizing kind of these older strategies that are taxable and things like that? Now, I'm not saying put every dollar you have into an index universal life policy, but what I am saying is that these gurus' advice can be a bit off the mark, and they've had time to realize how these kind of tax advantage life insurance policies work with Index Universal Life. Why have they not caught on? Hard to say. Could go against their worldview. I don't know. They don't really care because I know for myself, because I'm a policyholder, particularly with Allianz, and for my clients, we're looking to maximize our gains in the most efficient and tax advantage way possible. We want the protection of the 0% floor. We want to get market-like returns. We want that compound interest effect over the long run so that we can build tax-free wealth and be able to utilize it whenever we want to, whether in our working years or in retirement years, for any projects that we want, investments, retirement income, we can do it all. So this is, again, one of the reasons why I call permanent life insurance, index universal life, whole life, those kind of things, I call the foundational asset. We get uninterrupted compound interest that we can access tax-free. Okay, and it's something that should not be understated, okay? Because we want to be able to build our wealth in the most effective way possible and give the least to Uncle Sam that we have to. Okay, thank you for watching our video, Profiting with Index Universal Life, featuring our premier carrier here, Allianz Life. Okay, Allianz Life is on the forefront of the IUL market, offering a number of different notables, including dynamic hedging, the various efficiencies, the locking features, as well as a plethora of different strategies for us to maximize our policy's cash value growth over the long run. Okay, we want our policy to be as useful as possible and grow in the most efficient and tax deferred way that we can. Okay, thank you for watching. If you are interested in putting together your own policy, whether whole life, index, universal life, annuities, and such, feel free to click the link in our description. It'll take you to our web page where you'll see much of our information. On that web page, you'll also see a Book Now button where you can sign up for a free online consultation. Okay, so during that consultation, we'll take a look at some of your basic financial goals and how a policy can be most useful to you to accomplish those. We also do free policy reviews. So if you're already signed up for a policy with another agent, we do a free policy review to review your current policy and see if we can do something better for you. Okay, so we can maximize your cash value and maximize your policy to best fit your goals. Once again, thanks for watching. Click like and subscribe, ring the bell, leave a comment, okay? And I look forward to seeing you on our journey towards financial independence utilizing the foundational asset. Until next time.